Mutual funds, the most popular gateway to the stock market. They promise diversification, professional management, and access for everyone. But what are they really? How do you choose the right one for you? Let's break it all down, from the absolute basics to the smart strategies. A mutual fund collects money from investors with a common goal and invests it in shares, bonds, or other securities. Each investor owns units, representing their share of the fund's total assets. The value of each unit is called the NAV, net asset value, which changes daily based on the value of the fund's holdings. Types of mutual funds, as per SEBI classification. Based on structure. Open-ended funds. Buy or sell anytime at NAV. Highly liquid. Great for long-term and flexible investing. Close-ended funds. Fixed maturity period, 3 to 5 years. Traded on exchanges. Entry only during NFO. NAV may differ from market price. Example, fixed maturity plans. Interval funds. Hybrid of open close-ended. Purchases/redemptions allowed only during specific intervals. Equity mutual funds. Debt mutual funds. Hybrid funds. Solution-oriented funds. Other categories. Equity mutual funds. Invest more than 65% in equities. Large cap funds. Mid cap funds. Small cap funds. Multi-cap/flexi cap funds. LSS Equity Linked Savings Scheme. With Rs 1.5 lakh tax deduction, Section 80C. Sectoral/thematic funds, like IT, pharma, infrastructure. Focused funds, concentrated 20 to 30 stocks. Risk, return. High risk, high potential return. Investor type, long-term, growth-oriented. Debt mutual funds. Invest in fixed income instruments. Overnight/liquid funds. Ultra-short, short duration funds. Corporate bond funds. Gilt funds. Dynamic bond funds. Credit risk funds. Risk return. Lower risk, moderate return. Investor type, conservative, income seeking. Hybrid funds. Conservative hybrid, mostly debt. Balanced advantage, dynamic asset allocation. Aggressive hybrid, mostly equity. Multi-asset funds, mix of equity, debt, gold. Risk, return, balanced. Investor type, moderate risk appetite. Solution-oriented funds. Retirement funds. Children's education funds. Lock-in. Usually 5 years or till goal maturity. Other categories. Index funds/ETFs. Fund of funds, FOFs. International global funds. Gold funds. Real estate REIT-linked funds. Your money doesn't just sit there. A professional fund manager studies markets, allocates assets, buys and sells based on fund objectives. The performance depends on both market trends and manager's skill. Through SIP, Systematic Investment Plan. Invest a fixed amount monthly. Benefits, rupee cost averaging, discipline, power of compounding. Through Lumpsum, one-time investment. Good for large funds or market dips. Expense ratio, annual management cost, typically 0.5% to 2%. Exit load, fee for early withdrawal, usually before 1 year. Taxation, equity funds, STCG less than 1 year 15%. LTCG greater than 1 year 10%, above 1 Indian rupee lakh gain. Debt funds, taxed as per income slab, after indexation removal 2023 rules. ILSS, tax saving up to 1.5 Indian rupees lakh U/SADC. Define your goal, short-term, long-term, retirement, etc. Assess risk profile, conservative, balanced, aggressive. Compare returns, 3-year, 5-year, CAGR, volatility, expense ratio. Check fund manager's track record, AMC credibility. Diversify across fund types. Market risk for equity funds. Interest rate risk for debt funds. Credit risk, default by bond issuers. Liquidity risk. Fund manager risk. The future of mutual funds in India. With growing financial literacy, digital onboarding and passive investing, mutual funds are becoming the default wealth creation vehicle for the middle class. SEBI reforms, transparency, and investor protection mechanisms are ensuring mutual funds remain a trustworthy gateway to the markets. Mutual funds don't make you rich overnight, but they make you rich for sure over time. So start today, because the best time to invest was yesterday, and the next best time is now.